Hey, what's up everyone, and welcome to the School of Personal Finance. Today, we're going to be talking health savings accounts or HSA accounts. Now, these types of accounts just so happen to be my most favorite retirement savings vehicles. More so than a Roth IRA or a 401k or a traditional IRA, I love using an HSA for retirement. Most people, when they think of an HSA, they immediately go to healthcare expenses, to reimbursing themselves for out-of-pocket costs. But I am here to open your eyes and help educate you as to why you should be using this account for the long term, for your retirement planning. So hopefully after you watch this video, you will never look at these accounts the same and you'll start using them differently than you currently are. Or if you don't have one, you'll start doing a little bit of research to see if it might make sense for you to go out and get one. All right, let's get to it. All right, just a quick update before I get into it. I started the School of Personal Finance because I wanted to try to help as many people as possible. So I started the YouTube channel. But then I also wanted to be able to work with people one-on-one on their specific situation. So I started my own financial planning firm. Now I'm looking to kind of put those two things together. I'm in the beginning stages of working on a membership type site with different levels depending on what stage of life you're in. So it's very important to me to be able to work with people who maybe they're just getting started or maybe they don't have a lot of money and they would never be able to hire a financial advisor. So I'd love to be able to coach those people and mentor those people along by giving them access to like my financial planning software, by providing them with educational videos, and also being there for them if they have a big question or a big life decision that they need to make. But then having other levels as well for people who are maybe later on in life and they've done a good job saving. They have a lot of money invested for retirement. They need help managing that money. They need help with making big life decisions like college savings, or maybe they're getting closer to retirement. So I'll keep you in the loop. If you'd like to learn more about this, check out schoolofpersonalfinance.com. You can always join my email list and I'll send out emails as I get closer to making this thing a reality. But I just want to give you a quick update. All right, so let's start with what a health savings account is and why I love them so much. So now they were started in 2004 as a tax advantage savings account for individuals that have a high deductible health plan. So that's an important piece to this. You have to have a high deductible health plan as your insurance in order to be able to open and contribute to an HSA account. I'm going to come back to what a high deductible health plan is. This way you understand how it works and you can decide if it's the right thing for you. But first, I want to get into the tax benefits of the HSA account because that's really what it is all about. So now these accounts, it's like the tax trifecta. So you get a tax deduction when you contribute to your HSA. So you get a deduction just like you would with like a traditional IRA. Money you put in comes right off the top. It's a tax deduction. And then any growth that you have in the account, it is tax deferred. So you don't pay taxes on any of the growth that accumulates in the account. And then when you take it out, as long as it is used for qualified medical expenses, you do not pay any taxes when you withdraw the money. So there is no other account in the universe where you get those three tax benefits. Like if we compare it to a 401k, you get a tax deduction when you put the money in, the money grows tax deferred, but then when it comes out in retirement, you pay ordinary income taxes at that point. Or a Roth IRA or a Roth 401k, you get no tax deduction up front, then it grows tax-free, and then it comes out tax-free in retirement. But with an HSA, it is the best of all of them. Tax deduction up front, tax-free growth, tax-free coming out. There is nothing that is better than that. Later on in this video, I'm going to talk about the optimal strategy and how I want you to approach this account. But for right now, I'm just going to bang through all of the benefits and features of the health savings account. So another big benefit is that it's not like a flexible spending account where you don't need to use it or lose it. So you could roll this over year in, year out. You don't have to spend all the money in it. So if you contribute to an HSA and you don't use any of the money in a year, it just stays in there and it could be invested. So that is very different than a flexible spending account where you have to drain it by the end of the year or you lose it. The account is also portable. So if you lose your job, you leave your job, you change jobs, you could take it with you to your new employer. If your new employer doesn't have a high deductible health plan option, then you could just leave your HSA where it is. You could still use it even though you're no longer under a high deductible health plan anymore. You just can't contribute to it anymore. So as the years go on, if you don't have a need for it, you could just sit it there and let it continue to grow until later on when you do have a need for it. So it is flexible in that regard. You could also use it for your spouse or for your dependents. It doesn't have to solely be for your medical expenses. There's also no income limit. So you can make millions of dollars a year, but as long as you have a qualifying high deductible health plan, you can contribute to an HSA account. So now the limits on the HSAs for 2020, if you're single, you could contribute up to $3,550. If you're married or you have a family, you could contribute up to $7,100. And now for 2021, they are increasing those limits. So if you're single, you could go up to $3,600. And if you're married or you have a family, you could do $7,200 into your HSA. And if you're over the age of 55, you have a $1,000 catch-up contribution that you could make as well. And you could also make contributions the same as an IRA up to the tax deadline, up till April 15th of the next year. So April 15th of 2021, you could still go back and make contributions for the 2020 tax year. And now the list of things that you could use the money in your HSA account for is tremendous. You could use it for deductibles, for co-payments, co-insurance, prescription drugs, dental, vision, hearing, braces for your kids, infertility, the list goes on. And then once you're age 65, you could actually use it for your Medicare premiums, which is very nice. The one thing that you can't use it for are your health insurance premiums. So you can't reimburse yourself for the monthly premiums that you pay to have health insurance coverage. All right, so now what is a high deductible health plan? Or better yet, what is a deductible? So the deductible is the amount that you have to pay out of pocket before the insurance company kicks any money in. So if you have a high deductible health plan, let's say that your deductible is $4,000. That means that you have to pay $4,000 in the calendar year before your insurance pays anything towards your healthcare costs. Now, high deductible health plans, they do include like preventative visits. So like a physical each year, you don't pay out of pocket for that. That is covered. Or if you have to have like a colonoscopy, something like that, that would be covered. But the higher the deductible for your plan, the lower the monthly premium, the lower the monthly cost that you pay for the insurance. So if you have a $6,000 deductible, you're going to have a lower monthly premium than if you have a $1,500 deductible. So it's almost like a seesaw. The higher the deductible, the lower the premium. The lower the deductible, the higher you have to pay every month to have the insurance. So now some typical healthcare plans that you hear thrown out there are like a PPO or an HMO. Those are different plans. If you have one of those, you do not qualify for a health savings account. You have to have a qualifying high deductible health plan. And then these plans will also have what's called an out-of-pocket max. So what that means is that once you hit that out-of-pocket maximum, you are then covered 100% moving forward for the rest of that year. So here's some things to consider when deciding if a high deductible health plan is right for you. I mean, the first thing is you need to have some money saved because you have a higher deductible. So if you get into an accident, if you need to go to the doctor frequently, if you have high prescription costs, you're paying out of pocket until you reach that high deductible. So you need to have that emergency fund. You need to have cash on the side earmarked in case that does happen. So a good rule of thumb is to always have the out-of-pocket maximum in any year available liquid in case something does come up that you need to pay that money for your health care. Now also, your monthly premium is going to go down by choosing a high deductible health plan. So your monthly cost for your health insurance is going to be less. You should try to save that difference, put that difference aside. So if you do need to pay out of pocket, if you do have a medical expense that comes up, you have that money available for you. But these plans are great for people that are young, that are healthy, that don't go to the doctor very often, because now you have a lower cost every month, and odds are you're not going to hit that deductible. You're not going to need to go to the doctor and have high medical expenses. So this could really be a great plan for you. But now you do need to make sure that you keep good receipts. Like if you get a bill from a doctor and you have to stroke a check out of your checking account, keep a copy of that receipt for when you do go ahead and reimburse yourself, that you have a record of that medical expense in case you were ever to be audited by the IRS. So it is important to keep very good records and receipts of everything. And I recommend that you do it digitally, and you could even keep a paper copy as well, just so you have all your bases covered. Now, if you work for an employer, then they're going to have a relationship with an HSA company already, or a bank or whatever, and it's going to be set up right through your benefits department. The nice thing about this is it will go through payroll deduction, and then you save on FICA taxes as well. But you want to be cognizant of fees and the investment options that are available within the HSA, because they're not all created equally. So now if you're self-employed, or if you have the option of choosing the HSA company that you want, like Fidelity is a very popular one because they offer their whole investment suite and it's very low cost. You could choose low cost index funds. HSA Bank is another popular one. Now, one of the big questions that I get is, what if I need the money? What if I take it out and it's not used for qualified medical expenses? And what happens in that scenario is you can take the money out, but you're going to pay a 20% penalty and also ordinary income taxes. So it's not a great way to go, unless you're age 65. Once you turn 65, then it works more like a traditional IRA, where you could take the money out for anything, you won't owe any penalty on it, but you will pay ordinary income tax if it's not used for qualified medical expenses. All right, now let's talk strategy. This is what I'm hoping to open your eyes to. So the way that people typically use these now is they'll put money into their HSA and then they have a medical expense that comes up and they'll pay for the medical expense. And this is great. They get a tax deduction. So whatever your tax rate is, if you're in the 25% tax bracket, then you are saving 25% on your medical expenses, which is great. But there is a more optimal way that you could use this type of account. What I want you to do is to not use it for medical reimbursements right now. I want you to use it as a retirement account. This is the way that you take advantage of all three tax treatments that this gets. So you put the money in, you get a tax deduction. Now the money that's in there, you invest it. You can invest it in low-cost index funds. Invest it aggressively. Leave it in there for a long period of time. Try to get growth in that account. So now, if it grows over all these years and you save it for retirement, all of that growth is going to be tax-free as well. And then when you take it out, you don't pay any taxes on it as long as you use it for medical expenses. So you might be saying, well, what if I don't have that much medical expenses? What is great is that the IRS does not put a time limit on when you need to reimburse yourself for medical expenses. So you could save up the receipts each and every year. So let's say 25 years from now, you have $50,000 of medical expenses in receipts that you paid out of pocket. You could then go ahead and submit it all in 1 year, the year that you retire, maybe use it as a bridge to taking Social Security. Now, this is only going to work for people who are good with their money, who have savings, who have the money to the side to pay for medical expenses out of pocket. If, God forbid, they get into a bad accident and they have to pay the out-of-pocket match for the year, they have the money aside. This is to be used as another savings vehicle. So you have to be a saver in order to take advantage of this. But it's better than any other type of retirement account if you use it the correct way. So hopefully this opened your eyes to the best way that you could use these HSA accounts, and you won't look at it the same anymore going forward from here. I hope that you found this helpful. Please make sure to subscribe to this channel if you've not done so already. Hit that like button if you got value out of this video today. It helps so much with the YouTube algorithm and them showing my videos to more and more people. I'll see you again next Friday. Thanks.